Hey guys, it is Julie here with TipRanks, and today we're taking a look at 3 cheap strong buy stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. Today we're taking a look at 3 companies that all come in with a strong buy consensus from Wall Street Analysts, plus they are priced under $10 per share. So we're going to take a look at these companies, what it is that they do, and what analysts are predicting for their stock's future. We found today's stocks using the TipRanks Stock Screener. Found under Research Tools on the TipRanks website, we're headed over to the Stock Screener. Here I want to look for stocks that came in with a strong buy consensus, not just from all analysts, but from the best analysts as well, trading on the major exchanges, and also having an outperform rating on the TipRanks Smart Score. Of course, I wanted some double-digit upside potential as well. I then sorted the results by price and found a few that caught my eye under $10. First up, we have TransAlta. Their stock trades under the ticker TAC, currently priced at $9.23. They have had some ups and downs this past year and are fairly flat overall, up 0.5%, and have cooled off over 2% in the last few months. TransAlta deals in the generation and distribution of electricity. They are one of the largest renewable power producers in North America, one of the largest producers of wind power in Canada, and the largest producer of hydropower in Alberta. They operate a diverse and growing fleet of electrical power generation assets in Canada, the United States, and Australia, consisting of hydro, wind, solar, battery storage, gas, and energy transition facilities. TransAlta does pay a quarterly dividend, which is currently at 4 cents per share for a dividend yield of 1.7% and a payout ratio of over 22%. They did share their latest quarterly results at the start of August, where they came out with an earnings beat. For their Q2, they reported earnings per share of 17 cents, coming in 9 cents ahead of analyst expectations. And they had adjusted EBITDA of $387 million, which increased 39% year over year, and free cash flow of $278 million increased 94% on a per-share basis from the same period last year. Their president and CEO noted as well that with their performance across the fleet and continuing positive expectations for the balance of the year, they revised their 2023 full-year financial guidance upwards for both adjusted EBITDA and free cash flow. The TransAlta stock does currently come in as a strong buy based on 7 current analyst ratings with 6 buys and 1 hold. The average price target for the stock comes in at $12.35. That would be an upside potential of 33% from current prices. Down below, we can see our most recent rating came in just 6 days ago from a 5-star analyst at BMO. He gave the stock an upside of 35%. And most of our price targets are pretty close, ranging from 20% on the low end to 48% on the high end. The second stock on our list today is Crescent Energy. Their stock trades under the ticker CPG, currently priced at $8.46 per share. Now, they have seen some solid growth this past year, up 20% with a lot of growth in recent months, seeing 27% gains here. On their 10 out of 10 Smart Score, we've also seen some notable increased hedge fund activity. Crescent Energy deals with oil and gas properties. Based out of Calgary, Alberta, and founded back in 2001, the company focuses primarily on light oil production in southern Saskatchewan and central Alberta. They are one of the largest independent oil and gas producers in Canada and have a significant presence in the Western Canadian Sedimentary Basin. And they also pay their shareholders a quarterly dividend, with a current dividend of 7 cents per share for a dividend yield of 3.28%. Now, their last ex-dividend date was actually today on the 13th for payment on October 1st. They shared their most recent quarterly report near the end of July, where they came out with an earnings beat. Revenue came in at $619.47 million, and earnings per share of 29 cents was 2 cents ahead of expectations and broke a streak of a couple quarters where they did fall short. Taking a closer look, they did generate $278 million of excess cash flow and returned 60% of that cash flow to shareholders during the quarter. And just a couple of days ago, they did share their preliminary 2024 budget plus an updated 5-year outlook. In this updated 5-year outlook, the company did say that they're anticipating to generate significant excess cash flow of over $1 billion in 2024, and they are expecting disciplined growth of 5% per year, with longer-term outlook production increasing to 180,000 barrels of oil equivalent per day by 2028. Their management said that this inflection we are seeing in our business is a direct result of our strategy, which is focused on maintaining a resilient portfolio of high-return, short and long-cycle assets. Our disciplined approach is expected to generate sustainable returns and significant excess cash flow for our shareholders. Their stock has 9 unanimous buy ratings from Wall Street, and an average price target of $10.57 would be an upside potential of over 25% for this next year. And we have a lot of ratings coming in just a few days ago following that updated outlook, ranging from 13 to 22% upside, and a couple older ones following their earnings report go up to about 39.5%. Also great to see a lot of 5-star analysts weighing in on the stock as well. And our third cheap strong buy stock is Applied Digital. Their stock trades under the ticker APLD and is currently priced at $5.41 per share. Now, they took a big jump up here in May and another little peak in June following their earnings report, and are up 158% over the past year, but they have been cooling off recently and are down 38% in the last few months. Applied Digital designs, develops, and operates next-generation data centers across North America. They provide digital infrastructure solutions to the rapidly growing high-performance computing, or HPC, industry. With dedicated and experienced leadership in the fields of power procurement, engineering, and construction, the company collaborates with local utilities to solve the problem of congestion on the power grid while stimulating the development of more renewable energy. They reported their latest quarterly results near the end of July, and despite an earnings miss, they did see a jump up in stock price as they are forecasting a surge in revenue for 2024. For their Q4, they did report a loss per share of 7 cents, which was 2 cents wider than had been expected. On the revenue side, they reported $22 million, which did come in just ahead of analysts' expectations. The company also launched their AI cloud service to provide high-performance computing power for AI applications. And the big thing was their stronger than expected forecast for 2024, as they're anticipating revenue between $385 to $405 million, well above the $308 million that analysts were expecting. Their stock currently has 6 unanimous buy ratings from Wall Street, and their average price target of nearly $16 per share would be a whopping upside of 193%. The most recent rating coming in just 2 days ago from a 5-star analyst at Lake Street, who's anticipating upside of nearly 250%. So some pretty wild price targets coming from the analysts here. And of course, that leads me to my disclosure that some of these cheap stocks can be extremely volatile, and while they may have some great growth potential, they can certainly swing downwards just as quickly as well. So always make sure you're doing your own research and due diligence, understand the risk of any investment that you're taking on, and make sure you stick to your own investment plan. But also let me know in the comments what you think of these 3 cheap, strong buy stocks. I do always love hearing from you guys. Thank you so much for watching, and I hope you have a fantastic day.